I'm Keith McCullough, and welcome to another Real Conversation. This one's with one of my teammates. A lot of you have asked for conversations like this, and this one I'm excited to have with a long-standing member of the Hedgeye team, partner of mine here at Hedgeye, Josh Steiner. We've been together. We're just chatting quickly here. I had to remind myself, since 2009, right, man?
That's right. Yeah, it's been a long road.
Been a long road. So Josh was an analyst at Lehman Brothers, bad words in there, then was on the buy side. So we had a bit of a somewhat similar experience, and we both left one place to go to the buy side, and we both saw some pretty epic collapses, me at Carlyle, you at Amaranth. But you know, what is it like now? And again, I can't believe we've worked together for so long. What is it now about the job, I guess, the way that you would you'd look at what it is that you do that is so much different, if at all?
Yeah, well, I think it's different in a lot of ways. I think people are much more attuned to the things that we've been talking about for a long time, which, as you're familiar, is really the cycle. And within my world, it's thinking about the credit cycle. And I think the other things that have changed a lot is that over, I'd say, the last 3, 4, 5 years, there's been a growing focus on sort of the shorter term cadence of data and so forth. But ultimately, I think a lot of what it really comes back to is sort of thinking about the bigger picture of, you know, where are we in the cycle? What are the implications? Which are the areas, at least in my world, within financials that are best positioned here, worst positioned, and so forth. So it changes and evolves, but it always sort of comes back to those areas of focus for us.
Isn't it amazing, like how, and I always, it's basically the third cycle that guys our age, because we're roughly the same age, it's the third time we've been able to actually see a full and proper employment cycle, credit cycle, which are linked, inextricably linked. You know, in between all that, though, people get away with, picking stocks on valuation, this, that, and the other. But it's always the cycle that seems to run them right over, isn't it?
Yeah, without a doubt. And again, I go back to the financial crisis, and you look at the XLF from first quarter of 2007 to early March 2009. And the XLF was down about 85% peak to trough.
Woo!
So, it's pretty hard to avoid numbers like that. And, my focus is really on specialty finance and payments and housing. And I think those are a few of the areas that are particularly susceptible to the tails of the cycle. And so when I think about companies with cycle risk, of course, I always think about credit risk. And so, it's not a surprise that when you get to a moment in time like the one we're in now, and the one we've been in here for a while, that there's a lot of focus on this area, and this cycle is proving to be just as interesting as the last one.
Yeah, the last one, of course, and we mentioned the bad word of your former employer, which is no longer a Wall Street firm. But that crisis, the financial crisis, and by the way, fire your questions in the queue. I automatically, whenever I talk to anybody that is of your ilk, Josh, they'll go back to the 08 crisis. This is the 08. It's like that was the banks. This is their clients, and I can't, like, for the life of me, every morning when we do our morning call, or the call product that a lot of people that are listening to this listen to, I can't believe how bad, particularly at the consumer credit level, and you just did a big presentation on that, these numbers are, and they're just a function, I guess, of the labor cycle.
Well, yeah, that's exactly right. And I think, the challenge is right now, you've got right around 34 million people who are currently collecting unemployment claims. And when we look at it, we look back historically at the relationship between continuing claims and charge-off rates. And at the peak in the financial crisis, you got to about 6.6, 6.7 million continuing claims, and that produced a charge-off rate for credit card operators of around 10.5%. So up here at 34, 35 million, we're pretty much in uncharted waters. It works out to something like for every incremental 1 million continuing claims, at least historically, you've seen credit card charge-off rates rise by around 1.7%. So up in the mid-30s, that would get you to a charge-off rate that is, not compatible with life, as they would say, for credit card companies.
Well, life as a portfolio manager that owned these when you made the call initially is not good. And then, of course, people start to try to justify, well, if the company doesn't go away. But that's not why you owned it. You didn't own it because you thought the company could go away. You thought that the credit cycle was going to mosey on along. And a lot of people got really lazy with the consumers in great shape. I think Jamie Dimon's changed that to the consumers in good shape if you look at certain tranches that he wants to look at and ignore everything else. Just one more point on that before we get into your process. Like I think it was late last week, you were revealing to me, you basically separated the U.S. economy, which we really, I guess, kind of have to do to human beings when we look at the world from your perspective, into quintiles. And then when you looked at the bottom quintile, or the bottom 20% of America, what did it look like?
Not good. So if you look at the bottom quintile of earners in the country, people who earn under $36,000 a year, the percentage of people who've been laid off is around 37%. And of those people, about 42% have basically their expenses now exceeding their incomes. So they are tapping into their savings, what little, in many cases, they have, and also taking on debt in the short term to make ends meet. And one of the more interesting things, actually, in the data is that of those people who have applied for unemployment, so again, 37% of them have been laid off, of those who have applied for unemployment, only 30% have been approved. So, there's certainly a lot of talk about this idea that people are earning more, as much or more on unemployment as they were at their jobs, but that really only matters if you've been approved for unemployment. And as I said, about 30% of the bottom income quintile have been approved. So obviously, there are a lot of people who have been left out of this sort of unemployment, largesse that's come out through the CARES Act with its supplemental $600 of enhanced unemployment insurance every week.
Yeah, and I think it would be unobjective, and this is not a political statement, it's just a political poll. The political polls have changed in rate of change terms alongside a lot of that information. People losing their job, I mean, they're not going to be happy no matter who the president of the United States is, obviously. So that's something to think about too, because a lot of your sector is and was implicitly impacted by tax reform. And if you were to, most of what you're looking at now, correct me if I'm wrong, doesn't include a repeal of tax reform, or it would never include like picking a president or anything like that. That doesn't mean that those tail risks don't exist.
Yeah, well, if you think about over the last decade, two of the biggest sort of big picture events that have affected the sector, one was the explicit reaction to the financial crisis, which was the Dodd-Frank legislation. So Dodd-Frank came out and really did two things. One, it carried with it enormous capital surcharges that hadn't been there before, so that structurally lowered the return profile of basically every regulated institution in my space. Then on top of that, it made it, at least in that point in time, almost impossible for banks to make money on subprime customers because of the new regulatory environment. So it was a very different environment than the sort of decade or so that preceded it. And then at the other end of the spectrum, after the Trump administration was elected, there was a huge rally in the space, really driven by a few things. But one of the biggest components of that was this deregulatory agenda. And for a big chunk of my world, the Consumer Financial Protection Bureau, which is really sort of the Wild West sheriff that's there to kind of keep law and order, was basically hamstrung. So the acting chief, McMulvaney, basically moved people into the basement to deprive them of sunlight and take away any and all morale that was left at the institution. And with it, you saw just this huge reflationary trade among subprime operators. And so, looking ahead to November, if we get a outcome, at least the polls as they stand right now are sort of hinting at, you could expect, again, a massive reversal coming out of that outcome.
Well, I think Elizabeth Warren still likes that job, or the idea of that job, correct?
Yeah, and actually, if I'm not mistaken, she is still one of the front runners for the VP position. So from that seat, she would certainly be in a position to wield a tremendous amount of power. And you would see that almost instantaneously reflected in the multiples of companies across my space.
Yeah, and this again, you can't ignore it in having an opinion on the financials, because again, most of what happened here was a part of a massive corporate, and in Stephanie Pomboy's case, she called it, the mother of all bubbles here, that'll lead to the pension crisis, et cetera. But I mean, a lot of this is just woven in such a way that people will not be able to react once it's part of a new reality. So that's something I wanted to just get on the table. Back to your, let's just maybe, if you can, and you have a new product that's just come out, which is partly what we wanted to let people know here, the Financial Sector Pro product. So what we talk about internally is, especially with you and I when we're teaching some of our younger analysts to be, a little bit more gray-haired like us, I guess, is like, what is your process? What's your process? Like, if there's a one-liner at Hedgeye, that's it. So maybe you could give everyone your process to start, and then we'll get into some components of it.
Yeah, sure. So our process is really kind of the ATV of financial services. We kind of go anywhere, do anything. We do focus certainly within specialty finance and payments and housing. That's kind of our trifecta of where we spend the bulk of our time. But we really can go anywhere. And after doing this now for over 20 years, we've got enough experience to spot opportunities across the entire landscape. So we've got about 420 companies within financial services. Like I said, we like to go anywhere, large cap, small cap, could be domestic, primarily domestic, but can be international. So we really just range around looking for opportunity. And along the way, over the years, we've built a number of different products, largely data-based, but that really focus on a number of different both idea, origination opportunities, as well as sort of risk management tools that help us essentially keep fingers on the pulse of what's going on. So whether it's looking at sentiment from the sell side, buy side, insiders, looking at underwriting trends, looking at the quad framework, there's a lot of different basically risk frameworks that we sort of overlay on top of each other to think about different areas within the sector and how to ultimately keep a close eye on what's coming down the pike from an opportunity standpoint. So the product is really sort of an amalgamation of a lot of the different tools that we use here at the institutional level, just sort of at a more consumable level, I think, for the average investor.
Yeah, people need the tools. If I've learned one thing in particular on this last, not even the last couple of years or the 13 years that we've built this firm, it's in the last 3 months, people need tools. People on Wall Street traditionally have been sold picks. Like, give me your picks. Put somebody on CNBC, give me your picks. I don't, I always say now, I'm not your proctologist. I don't want to pick anything. I want to have Josh Steiner go into the garage and pick, all the different tools that he could show you that a pro would use to analyze the sector, and lo and behold, what you come out with are parts of, like you said, in the subsectors where you're currently bullish on housing, but you can be bearish on the credit card stocks, and that's great. But you don't use the same tools to analyze those two in particular, do you?
No, we don't actually, and that's really what we've refined and built up over the last decade here is very specific tool sets for each area. So that I think it gives us a very good holistic representation of where things are, where the way we like to frame it is where we are, where we're headed, and a little bit of perspective of where we've been. And that really gives you sort of the full framework to understand it. It's, it's not just this sort of, here's a very specific moment in time. It's really the context of, this is why this is interesting. This is the duration over which we expect this to play out, and here's why. Here's a comprehensive representation of really everything that we think you need to know in order to feel comfortable understanding this.
Yeah, I feel really uncomfortable, and that's why I obviously don't watch it. When somebody starts with valuation and they don't start with everything that you just said. Now, tell me a story about valuation after you told me everything you just said. Okay, that's part of the job. But there's so many people, particularly in the financials, because they're so bloody boring most of the time, that they always get stuck, and they've stuck again this year. I mean, the XLF, which includes the biggest position in the XLF is Berkshire Hathaway, but I mean, it's still a train run. The thing's down 22% this year. And people, like, they still go back to that all the time. Oh, but they're cheap. Oh, but they're perpetually cheap. They're not doing the rate of change analysis. They're not, they don't seemingly have a lot of wherewithal with the cycle and all the microcycles, if you want to call them that. You probably wouldn't call them that in between.
Yeah, well, I think that's one of the things that that we've sort of learned here over the years is that, the sectors, the subsectors, the individual stocks really operate along a continuum of valuation. And what I've found is that, and again, it depends a little bit on sort of where you are within the space. Some are a little bit more beholden than others, but ultimately, valuation really is, I don't want to call it irrelevant, but largely irrelevant within, call it the sort of, mid 3 quintiles. I think once you get out to those sort of outer tails, those tail bands where things are, let's call them outrageously expensive or outrageously cheap, then I think they become sort of more notable, because that's a point at which, okay, we've clearly gotten pretty far to one side of the boat here. We're leaning one way pretty aggressively, but ultimately sort of en route from, call it A to Z, I think the things that drive stock performance and sort of perpetuate these multiples really is much more about the narrative and the story and, the rate of change in the data and, what's happening sort of day to day, week to week, month to month. And that's something we've been really focused on over the years, trying to sort of figure that out and get that right. And ultimately, we're always sort of conscious of valuation, but it's incredibly rarely within our sort of top 2 or 3 bullet points on any given idea.
Incredibly rarely. Channeling your inner Trumpian there. Let's just do an example of that, because we have, we're bearish, you're bearish on American Express, Capital One, Synchrony. You're going to Discover down the list, and you're bearish on them, most importantly, before the collapse. And now, anytime I see any commentary on these stocks and why I shouldn't short them or why our clients shouldn't short them, and by the way, 50% of the calls that we make are shorts, because we don't run an investment bank, we don't have a broker-dealer, and we're not tied to the Federal Reserve's, ear-licking currently, whatever fest you would like to do if you like to cuddle up to their lobes and just love them. That's not what we do. We tell people, we help people to short stocks, or we help people get out of stocks so that they don't lose 50 to 80% of their money in a stock. I mean, that's a problem generally for most human beings. So let's maybe, and I think you could probably cite some slides of our content so that you can kind of take people through a live example of something like that.
Yeah, sure. I think the idea here would be, if we rewind the clock here a couple of months, and we were looking at, some of these credit card stocks by way of example, and you think about sort of where we were in February, things happened very, very quickly. And at least in the case of, some of these direct consumer unsecured lenders, names like Capital One, for instance, to bring back valuation, we were watching the valuation on these stocks because at one point they were dropping, north of 20% a day, which is a pretty extraordinary environment. And when things got down into, the sort of 0.45 times tangible book multiple on Capital One, that's where we called it out. We said, look, this is the low water mark for where this company in particular got during the financial crisis. That's not to say it can't go lower, but obviously at this point, you're pretty heavily on one side of the boat. And sure enough, that was really sort of a level where things bottomed out in the short term and roared back a bit. But now we're back at a level where, we think things have gone very much the other way. And now we look at this dynamic, as we talked about earlier, with where claims are, where the company's reserving is. You listen to what the company is saying, and they're talking about Q2 provisions being on par with Q1 provisions. And actually, the whole industry is saying that. And they're really talking about a lot of uncertainty going into the back half of the year. In other words, The challenge for them is that right now you've got a tremendous amount of transfer payments out there, right? Government stimulus in the form of enhanced unemployment benefits, direct stimulus checks. You've also got a tremendous amount of forbearance. So mortgage forbearance programs are up around 5 million. You've got card and auto forbearance programs that are very significant, ranging from 1 to a couple of months. You've got student loan forbearance programs that are in effect until the end of September through government programs. So you've got a lot of stimulus and you've got a lot of forbearance, and those are all setting up to basically end right around the same time, which is in the second quarter or in the third quarter and rolling into the fourth quarter. And so the question that's on the mind of all these CEOs and on our minds as well is, well, what happens at that point? And one of the big uncertainties that we're tracking very closely with our Washington group is, what does this next round of stimulus look like? What does it carry in terms of additional stimulus payments? Does it extend the enhanced unemployment benefits? If so, to what extent? For how long? All these things, because without those transfer payments, then you are in just a profoundly different world from where you've really been over the last 2 months. So that's what we're watching closely, and that's how we're thinking about it.
If you look at like what these, and I always find it fascinating to listen to Wall Street executives or publicly listed, company executives talk about the outlook, in an environment like this where they've never, in some cases, never spoken about it. You do, I think you always allude to the Capital One CEO in particular as being different than the fine folks at Synchrony. But I think like something like the slide 19, guys, that's kind of core to how Steiner looks at it. This is what would you call this? YouTubing management, or highlighting the truth or dare part of it?
Yeah, I think that's right. And I mean, look, I think the CEO of Capital One has been around a long time. He's also a hockey player, so I think that probably grounds him to an extent in terms of being sober with respect to his outlook and being appreciative of where we've been in the past. And it also helps, or at least doesn't hurt, that he was basically the pioneer of subprime lending. So he's a guy who we have tremendous respect for. And when he gets on the call and basically says that we really don't know where all this is headed, we take that with more than a grain of salt.
Yeah, he's actually slide 25, the Capital One guy. Slide 19, you'll come back to, I'm sure, is the Synchrony guy, Fairbank.
Yep. So I mean, this is an excerpt from a recent conference presentation where he talked about the forbearance dynamics, and on the plus side, new requests for forbearance have been trending down on both card and auto. On the negative side, the number of auto loans that are currently in forbearance are 13% of loans and 15% of loan balances. So, I mean, think about that for a second. You've got 15% of auto loan balances in forbearance. That's on top of what's already delinquent. So, I mean, those are like unprecedented numbers. We've never really seen numbers that high before. And people are okay with it and comfortable with it, because the idea is that eventually these people will come back to being, in paying in full. But what happens if they don't? And I think a lot of that rests in the hands of this next round of Washington stimulus. So what we did in this deck is we really just quantified, here's the risk if you don't get more stimulus. Here's how that risk is going to play out, and here's where we think things could potentially go. And I think that's exactly what you get from an honest CEO like Rich Fairbank over at Capital One, who tells you, look, we're setting aside as much in 2Q as we did in 1Q because we really don't know.
Mm-hmm. What do you think? Who do you think is the least believable out of these management teams?
Well, I think I don't know if I'd say least believable. I'd say the people who probably are at the greatest risk of being wrong would be the folks over at Synchrony and the folks at American Express. So Synchrony is facing a lot of the same issues that Capital One is facing. They have a large subprime business, but also they have the added sort of insult of having just a huge exposure in their footprint to traditional brick and mortar retailers, which of course are still struggling immensely here, even with reopening starting to starting to take shape. On the American Express side, they have sort of a different set of challenges. Their core business has been under a lot of pressure for a long time, really for the last 10 years. And they've sort of made up for that pressure in their core business by growing their loan receivable book very quickly, late in the cycle. And so that's created risk, basically adverse selection risk, that we think is underappreciated. And unlike the other stocks, Amex is trading at a much higher multiple. So those guys are trading at a little over almost 3.5 times tangible book value, which just creates a lot more downside if things don't go the way that these companies are hoping here with this next round of stimulus. So I think there's a lot of room for downside, both in Amex and in Synchrony.
Yeah, on Amex, guys, slide 32. I mean, Amex is uniquely, in as much as Synchrony is uniquely tethered to crap retailers that have now officially gone away faster. Amex is just absolutely inextricably tethered to T&Es. T&Es, who the heck is going to tell you that T&Es are going to reaccelerate?
Yeah, well, that's
and to what?
Yeah. Exactly. Yeah. So T&E for American Express is a huge part of their business. It's about 35% of revenue. It's about 30% of volume, but it's a higher margin business. So it's about 35% of revenue, and it was down 100%, which is pretty impressive. It's bounced back, now down about 90%, but that's not really going to get things done for them, and it's pretty interesting. We maintain trackers on things like Visa and MasterCard, their cross-border business, American Express, their T&E business. And while we're seeing recoveries in a number of businesses, one of the areas where we're seeing almost no recovery is in T&E. So that is going to be a challenge for them for quite a while, at the same time that they've got all this risk percolating up in their loan book.
Mm-hmm. Well, these loan books can be a house of cards sometimes. I mean, when they decide not to tell you the unadulterated truth all the time, which may not be what you actually get. But on this, we have, as opposed to what we think, our style is to track it. Get the weekly update, get the daily update, and if indeed that's what you're doing, I think that's what you do with some of your trackers, obviously. And whatever it is, it is. But recovering from down 100 to down 80 to down 50 is in no way, shape, or form the business that people owned. And now with the stock market and broadly some of these stocks having bounced as much as they have, I can't for the life of me understand why somebody would go ahead of American Express's quarter, or Synchrony for that matter, and say, I got to own this stock. It's all in it. What's in it? They don't even know what's in it.
Yeah, well, we're on the same page there, because I struggle with that too, and I think basically there was sort of a waterfall phenomenon where people sort of rushed back into things that were, at least on the margin, a little bit safer, a little bit more defensive, tech and so forth, healthcare, and then from there it just sort of kept rippling down, and by the time it got to my world, which are a bunch of unsecured lenders, the rally just didn't really make a ton of sense. And a lot of it rested on this narrative that, these transfer payments are huge, and a lot of people are now making as much or more than they were before they were let go, and so that's actually been a good thing for them. But again, where are we going to be here in a few months' time? And ultimately, we are just in an unprecedented level of unemployment. Since these companies have been public, we've never been in an environment like this, and yet the stocks have reflated a massive chunk of this discount. So to me, that sets up very, very precariously.
Yeah, the guys, throw up slide 5. Again, it's a damn shame. It really is. It's an American shame. It's un-American, I think, for CNBC and all the old wall media networks to not. Anytime somebody's talking about this stuff, just show them the numbers of people losing their jobs. Just have it beside people while they're talking, and then with a straight face say that the bottom's in and we're V-bottoming. This number, by the way, this isn't like a 50-day chart. This goes back, across all 3 cycles, going back to the year 2000. It's unanalyzable.
Yeah, this is a slide from a presentation that we put together last Thursday, and it went back and just tried to put into context where we are here so far in 2020, and as you can see on the chart, there's been 46.5 million applications for initial unemployment claims. And by the way, that's just on the state side. That doesn't even include PUA, which is still more than 3 times where we were in the first 23 weeks of 2009, which is obviously the peak of the financial crisis. And so, again, purpose of this chart is really just to highlight just how different this current environment we're in is relative to years past. And by the way, that 46.5 million number includes January and February, which were actually not all-time lows, but just about all-time lows in terms of new claims. So it's even including in there 8 weeks of those 23 with record low levels. So that gives you, or should give you, an idea of just how bad that is.
Can you also just, PUA, thanks for explaining that again. I think a lot of what we do is about awareness and education. And then, like, if you do all that, then you can start to maybe have an opinion and God forbid, get yourself a Robinhood account and start whipping it around. But there's a lot of required reading and institutional knowledge here. How about how do you explain to people when a job loss or jobless claim goes from temporary to permanent? Because the government's going to say that it's all temporary and we've V-bottomed.
Mm-hmm. Yeah, so there's a slide in that deck that actually has a snapshot of the initial claims report, which we can maybe spend just a second on, because I think maybe just to help people understand. So, at the top, you have the state program, which is the program that's always been around since the program started. And the idea here is that you get initial claims at the top there. So most recently, 1.5 million. That was basically unchanged week over week. So actually the June 13th was 1.5 million. This is showing the June 6th week, basically flat at 1.5 million. Then you've got continuing claims, which is just below that. So as of May 30th, that number was about 20.9 million. The most recent week, June 13th, again, about 20.5 million. Then you've got a whole new category, which didn't exist prior to a couple of months ago. It was rolled out as part of the CARES Act, and it's called the Pandemic Unemployment Assistance Program, or PUA for short. And so far, you've had about 10 million people who are collecting unemployment benefits under PUA. So you've got 20 million through the traditional state program, but then you've got a further 10 million coming through the PUA program. So about 30 million. And actually, when you add up the recent initial claims with those who are continuing claimants, you get up to a number in the mid-30s. You're around 34 million. So in terms of thinking about, how many of those ultimately are permanent versus temporary, the best thing we've come across so far is a paper that was authored by some University of Chicago folks in conjunction with one of the Federal Reserve banks. And what they found is they looked back historically at the transition rate from people who were laid off temporarily under furlough programs or temporary layoff programs, and what percentage of them ultimately became permanently unemployed. And they applied that data, that historical data, to the current pandemic situation, and they estimated that 42% of the people who became unemployed as a result of the COVID-19 pandemic would become permanently unemployed. So if you think about that 34.5 million figure, that works out to about 14.5 million permanent layoffs, which on a denominator of around 150 million works out to around 10% unemployment. So that's where we think we're going to settle in at here over sort of the coming couple of quarters. And again, to put that in perspective, that would be right in line with the peak of the financial crisis. So, I think you guys have talked about this a fair amount on the macro side, but I think what you're sort of looking at is this idea of transitioning basically from depression level statistics to very deep recessionary level statistics. And I don't think where we're at least not in my space, reflects anything like that, at least from where the stocks are trading.
Well, I think what a lot of people want to believe, if only because that's what Wall Street spews to them every single day, is because the worst of that hit the quote-unquote bottom of a depression, any recovery from there is a big economic recovery. When the obvious distinction between the two views is that going from a depression to a recession, the worst we've ever seen, worse than '08, if you actually start to think about this more broadly, because of course it's like consumer and corporate credit at the same time with a series of bubbles as far as the eye can see in private equity, venture capital, et cetera. I don't want to go off on that. But again, the reality is that that's the difference. People want to believe that that's it. I mean, here's a question in the queue that basically I could read this thing 10 times and it could be from 1,000 different people watching CNBC all day long. If the jobs data gets better, rate of change is better, which is clear in your process to make stocks rise. First of all, that's not clear. But I hear you. I'm reading it. Is this time different? And it's not a bear market bounce. Are we expecting the financials to fall as the jobs data gets better? What am I missing?
Yeah, so I think that's actually a really good question.
I think
the way that we think about it is that duration of unemployment matters a lot, and it's actually going to matter a lot more this time than in times past because the amount of stimulus that's been put out there by the government has really held back very significantly the impact. So if you think about the way things work, right, normally you would have a relatively short lag between the increase in jobless claims and the deterioration in credit metrics, i.e. early stage delinquencies and the flow through of those delinquencies into charge-offs. This time around has been different because people who have been getting let go are receiving so much in transfer payments that you're not seeing that flow through to delinquencies. So what we're concerned about and thinking about from a sort of progression is that you could have a very odd environment here over the back half of 2020 where you're going to have the labor market ostensibly getting less bad at the same time that you're going to have very significant increases in delinquency metrics. And ultimately, it's those delinquency metrics that generate provision levels for lenders and obviously determine earnings power over the intermediate term. So we think you're going to have a pretty different environment. And there's actually a chart in this slide deck that shows the savings level on the part of Americans. So it shows like whether they have $100 in savings or $1,000 in savings or $5,000 in savings. And to me, what's pretty striking about this chart that shows these savings levels is frankly how little Americans have saved. So I think it's a very high percentage of people only have about $400, $500 in savings. So when you think about their vulnerability, it really becomes a function of duration of stress, right? Because if you're talking about not being able to make the upcoming rent payment, mortgage payment, or car payment, credit card payment, that's really going to be a function of how long am I under this sort of cloud financially? And then this is a chart here that looks at do you expect to fall behind on your auto loans or your credit cards? And these were surveys that we conducted in early April and then again in early June. And what's interesting is so on the left of each chart, you have the percentage of people who are responding saying that I've already fallen behind and or I'll definitely fall behind. And for credit cards, that was 9% in early April and almost 14% in early June. And then in the middle there is a really much more concerning category. This is the percentage of people who basically said, I'm going to try not to fall behind, but I may. And these are the people who are really paycheck to paycheck and don't have much in the way of capacity or cushion to deal with any kind of shock. And so for those people, again, it's duration. So if the environment remains difficult for longer than people think, then you're going to see some portion of that 28.8% starting to fall behind on top of the 13.5% already saying they're either behind or will definitely fall behind. And so for perspective, the current delinquency rate in credit card lending is in the very low single digits. So you're talking about seeing that migrate up from there to at least 13, 14%, and potentially a lot higher. So, with respect to, if rate of change in jobs is going to get less bad, rate of change in delinquencies is going to get a lot worse. And I think that's what people are going to be focused on here over the back half of the year.
Well, it's what a lot of people totally screwed up in 2001, is that there are multiple cycles and then there are cycles within a cycle. So if you ask Josh Steiner, we're talking about certain cycles, credit cycle, housing cycle in particular, and again, loan loss provision cycle. There's cycles, okay? But in 2001, GDP from a cyclical perspective bottomed. You could barely see the recession. But earnings didn't bottom and the stock market didn't bottom till 02, or at least back earnings started to bottom by the end of 2001. But again, that's the point. And that's the point once we get to earnings season. Anybody who wants to draw a V on a chart is going to say, well, that doesn't look like a V. That looks like we're going to the lowest part of earnings for this company of the modern era. And it's a negative number. It's not a positive earnings. In many cases, these companies are actually starting to lose money.
Yeah, and think about this too. I mean, one of the big catalysts for the financial crisis was basically the expirations on these 129 and 228 products, right? So you had a huge chunk of the housing market funded basically on a fixed payment structure for either 12 or 24 months, which then basically reset or recast from either a negatively amortizing to fully amortizing product. And it wasn't a big deal because people could generally refinance as long as home prices were rising rapidly, so no big deal. Until home prices weren't and people suddenly couldn't refinance, and then all of a sudden you had all this payment shock. So we're kind of setting up for a similar dynamic here later this year as we move into the fall, because you've got almost 5 million people who currently aren't making any mortgage payments, and they will come up for renewal on that in September, October. Now, there is the potential for them to extend for a further 6 months, but the bottom line is think about the impact that's having beneficially on spending. And then you think about state level rent or eviction moratoriums that are in place. You're seeing sort of a mini version of that. And then you've also got these forbearance programs in place on card and auto. So people are, in a position right now where they're doing much, much better from the standpoint of, I don't have to service debts currently. And that's going to change very shortly here. So, and we've seen this multiple times where when you get to these sort of moments in time where you have a large number of people who basically are having small amounts of obligations to having large amounts of obligations, when you take that step and you transition from that sort of pre to post period, it's just not a good transition. So again, thinking about rate of change, that's certainly one thing on the labor side, but there are a lot of other considerations here.
Yeah, always, all the time. Your questions, please fire them in the queue. They get upvotes and downvotes. The top voted question for some reason is about REITs, which is fine because, you have views on the housing side, which I'll let you answer the question on that. And questions pertain to Quad 3, Steiner. So, some people are concerned, this guy in particular, which is a rightful concern because he's citing what the conversation I had with Steph Pomboy last week, saying, hey, look, I get it, corporate leverage, bankruptcies, and the special nature of the pandemic. Does the team have concerns about REITs fundamentally in a typical Quad 3 environment? Well, the answer is we're always concerned about everything all of the time. Let's start with that. 2, if the VIX is where it is today or higher, you should be concerned about anything that is a stock in any sector. So let's circle that too. Quad 3, if you have a deep Quad 3, it's very bad for a lot of things that are real estate oriented. Whereas if you have just a run of the mill or a narrow Quad 3, something like housing does good in Quad 3 because interest rates or real rates are relatively low. Is that not correct, Josh?
Yeah, well, I think REITs is a pretty big category.
Yeah, very.
And I think there's different areas within REITs that you sort of need to differentiate from each other. So I think if you're talking about the office REIT space or the mall REIT space, I think those areas are incredibly challenged, and we could certainly go into why, but I think a lot of the reasons why are reasonably straightforward. I think the demand for office space is going to be in secular decline here for quite a while coming out of this. And then the mall REIT space has sort of been the perennial redheaded stepchild, and I don't think that's going to change here as a result of this sort of reopening, which isn't doing a whole heck of a lot for these brick and mortar operators. I think there's one area within REITs that is really interesting, and that's the single-family REIT space. And that's an area where, we've been sort of positively biased here for a while. We've never really done too much work in the space, but the general idea is that these are single-family homes that are available for rent, as opposed to what is traditionally for rent, which is multifamily apartments. And this is really a play at this point going forward on the idea of what we're seeing post-COVID, which is people basically want out of urban areas. They want more space. They basically can work basically from anywhere. And so why not work from a lower density place? So I think, again, it really depends on sort of where within the REIT universe you're talking about.
Yeah.
And then, of course, rates are always first and foremost. So we would think about rates in the context of what quad we're in. But those are sort of the different things that I'd be thinking about with respect to the different categories of REITs.
And we also, REITs, basically, you need a whole research team to cover all the REITs because they're also sectorized like our team would be. So we have like 40 analysts, God willing, we'll have 80 and 100 one day, and we'll cover the whole waterfront. And then we'll properly be able to answer that question at every sector level of REITs. So for example, Todd Jordan, as you heard him this morning on the call or in our morning meeting, he gave me 4 new shorts, which are basically hotel REITs. So the answer on hotel REITs is we want to be short hotel REITs, which is, again, a different answer than the broad ETF like XLRE. So you can buy that. You could short. He had PK, which is Park, XHR, PB, and Host. PB is the ticker, and then or HST, which is Host. So again, yeah, that's the answer. That's how we roll. That's actually how you'd hear us communicate it on the call. The whole idea with Steiner and Jordan and everybody else that have their, in his case, the Financials Pro product is that so then you can look inside of their aquarium and start to look at all the different shiny objects. Because again, I've only gotten you from the macro asset allocation to the sector. Then you go inside the sector, and that's what Josh is tasked with. Maybe I'll just roll through some of these questions here, Steiner, because they're starting to pick up in terms of pace. Let's see here. Let's go to. Okay, here's a good one. The Fed believes banking is essential or the heart of the economy. In the 1990 savings and loan crisis, the Fed engineered an interest rate spread between deposit rates and five-year treasuries to nurse banks back to health. Is it likely that the Fed will be able to do something like that again?
No, I don't think anything like that's in store. I think if anything, we're going into a completely different environment, which is just a secular lower for longer dynamic. I think the Fed basically has a view that the primary thing it can do to help maintain the solvency of the banking system is through higher capital requirements. So the Fed is completely comfortable allowing for lower returns on capital in that environment. And that's really the path we've been on for at least the last 10 years. I don't see any change there. I think looking ahead, I think one of the big challenges for the banking industry is really going to be this rate environment because, it was just starting for very briefly to look a little bit less bad than it had been for years. And then all of a sudden that went the other way. So, this has been an area of perpetual struggle for a decade plus now. And so now you've got rate headwinds, you've got credit headwinds. Presumably in the fall you could have regulatory headwinds. So it's going to be a very tough environment for the banks. And I think the only thing the Fed is really doing is helping certainly on the liquidity front, but also pumping money into the system for now. But ultimately, we will be on the other side of that and not in a good way. So I think that's kind of the challenging backdrop that the banks are going to have to navigate through.
Yeah, we're trying to solve a leverage problem with more and more and more leverage and less and less and less cash flows underpinning the leverage, okay? Write that down. You don't hear it all day long. You should, because that's just the rate of change, reality of it all. On the positive side, just because this is something that you've nailed, and really it's shocked me, both locally in my own hometown of Westport, Connecticut. It's a boom town now, as you and I talk about sometimes on the morning call. But this has to do with these weekly mortgage applications and the data series. Andrew says they're on the rise. What trends are you seeing in terms of banks tightening or loosening credit standards for these mortgage loan applicants?
Yeah, so we've actually had 9 weeks in a row now where the weekly mortgage purchase application index has risen week over week. So pretty incredible run.
Yeah.
On the flip side of that, you have just an enormous tightening in credit availability. So the MBA every month publishes its MCAI, its Mortgage Credit Availability Index, and that index has fallen from around 185 down to 129. So you've seen a 30% plus reduction in credit availability. So even though we've bounced very significantly off the lows in terms of the number of applications that are being filed, the reality is that the number of actual transactions is not rising anywhere near as fast. And actually, if you look at the existing home sales report this morning, it was down pretty sharply month over month. And I think the more important reading is actually going to be the pending home sales number for May that'll come out a week from today, because that'll give us a better insight into really where the sort of juncture between these rising apps and these falling credit availability standards are sort of meeting up. So, definitely less bad on the housing front, but if you can't get a mortgage and you can't take advantage of record low rates, there's only so far you can go with that.
Yeah, that's an important delineation. Another thing that you've been bullish on, and this question has to do with one of these names, are the debt collectors. So this question is, Josh, can you comment on the regulatory risk to one of those names, which is PRAA, that's the ticker, and the other one is Encore Capital Group, which is ECPG, but this one has to do with PRAA. I don't know why they picked that one. In the event of a DEM sweep is what the question says.
Yeah, so these are two of our favorite ideas on the long side, namely because they are direct beneficiaries from all of the challenges that the credit card companies are facing. So as charge-offs rise, these are third-party companies that are basically out there buying up these charged-off receivables, and then they spend the next 8 years trying to collect on those receivables. And so, if you look back through history, every time you come out of a significant economic slowdown, these stocks have been the best performing stocks within all the financials. And there's only two of them, Encore and PRA. Now, on the flip side, it's not all roses, because they are also very vulnerable to regulatory change, and specifically actions at the Consumer Financial Protection Bureau. So if we do get a DEM sweep, as the questioner called it, in November, that is going to raise some significant regulatory risk for these companies. It's hard to know exactly what that'll look like, because Biden hasn't really said anything about what his sort of priorities would be. It would also depend largely on what role Elizabeth Warren plays in all this, because she was essentially the creator of the CFPB. And, so we'll see how prominent a role she would be playing in all this. So there's definitely a lot of moving pieces, but this would be the single biggest risk in my mind to these names on the long side.
I mean, if you go back, first of all, it was a great call by you, because again, you went to a place where, you're basically, what was ECPG trading at, like 2 or 3 times earnings? That's what you meant by, and again, that's not where you started with. You incidentally mentioned that, obviously, after you're talking about the cycle, or the part of the cycle that the company is on. But I think that's how cheap it actually got. That's what you mean by the tail of like extraordinary valuations.
That's right.
Yeah. I mean, that's bananas. Here's actually this question. I get these questions a lot, and I don't have specific answers. Like Steiner can forget more on the way to the bathroom, with particularly on financial acronyms, by the way. So if you want to know about any of this stuff, but this guy's like the guy's name is "Don't Take My Pension," and Gavin's asking about CLOs, and people are hearing more and more about CLOs. They exist. To simplify the complex, if you can, how would you say? Do you think that the Fed has put a big ring fence around that risk, in particular on the credit side?
Well, That's a tricky question. It's actually a straightforward question with a tricky answer. Um,
As all financial questions are.
so I think if you look at CLO performance, delinquency rates are rising very significantly in CLOs, and I think the general asset quality that's gone into CLOs has deteriorated immensely over the last few years. So on its face, I would think you would be extremely concerned about the CLO market. The reason I say it's a tricky answer is because the Fed's actions moving into the high yield market, moving into the investment grade market, obviously on the government front, are such that it's essentially created enough of a bid for risk across a very broad swath of the credit landscape that CLOs have not been accepted. So, you've got this sort of odd bid for CLOs, even though the credit quality there is diminished and deteriorating. So yeah, it's a little bit of a funny animal, and from my perspective, it's the kind of category that I really wouldn't want anything to do with, because ultimately I just come back to, well, what's in it? What are the loans that are in there, and how do we feel about those on an individual basis? And from what I've seen, it doesn't look great. But if you want to sort of piggyback onto the Fed and everything they're doing and buying, then I guess be my guest.
How about, just as a last question, because we've running out of time here, like you deal, most of your day is dealing with these very institutions, clients obviously as well. They can be a pension fund, mutual fund, hedge fund. We do business with insurance companies. Actually, we have a mortgage client in the mortgage city, which is now the former Motor City, Detroit. What is it about, I know this is going to be a kind of a blanket type of a question, but do people wholeheartedly on the client side have full faith and belief that the Fed has figured this out and it's all, all up and away?
Well, when I talk to clients who I've known for a very long time and who I've developed a tremendous amount of respect for over the years, and really just their understanding of the markets and the different moving pieces and the companies and so forth, they are, this might be too strong a word, but I'll say it anyway, apoplectic over the rally that we've seen throughout most of the financial space. And they really just come back to the core fundamentals the same way that I do. And they just sort of are left scratching their heads and trying to really make sense of all of it. And I think, when you think about the magnitude of the transfer payments again, and you think about the extent of the role that the Federal Reserve has played here, you can get to maybe a bit of a justification, at least over the short term, for why there's been this reflation trade. But when you sort of, again, come back to this idea of the labor market backdrop and where that is likely to be later this year, and where will we be once we're sort of post this stimulative environment, I think you're just left with far more questions than answers. At least that's what I've gotten from clients. And so, I think people who are paying close attention and really have a good sort of working longer term framework are frankly in a similar mindset to us. I think the people who are maybe just really much more sort of short-term focused on things and thinking more about these dynamics in the short term, they're sort of happy to sort of ride the wave up and down and so forth. So, obviously to each their own, and those are the different durations that people operate under. But that's, most of the conversations I have revolve more around the idea of, well, how can this be, and why is this the case? So,
well, it's an interesting one, and unfortunately it's not a culture of questioning that is, again, espoused by the CNBC or the old wall. And again, the whole point is that guys like you and I have been doing this for now over 20 years, which is kind of crazy. But the people we're talking to are still doing their job. That means that they didn't get just full hook, line, and sinker complacent at the wrong times in 01 and 08 in 2020. I sometimes have a failure to communicate like what's actually happened to people's money in 2020. Post the bounce, fully loaded. I mean, financials again are still down 22% for the broad XLF for the year. I mean, so it's been a hot spot. I think it's been a spot that's certainly frustrated people, bulls included. I mean, if you go back to only the most recent I called capitulatory lower high on that day of the jobs report, where the government effectively misstated the jobs report. You know, that was in as much as I get, how could you miss the bottom, Keith? How could you miss the bottom, Steiner? Actually, you know, that's not how we wake up thinking. But again, how could you have missed that lower high? You don't understand that? You didn't know that was not the right number? Maybe on that last one, because on Twitter and your following's growing, you got a lot of people's heads turned that day when you were explaining the delta on what the real jobs, I mean the monthly jobs report, what that number actually was.
Well, yeah. So the May jobs report had a footnote in it that most people didn't really notice, but it basically
big
said
footnote.
Big footnote. Basically, 4.7 million people were classified as employed, even though they were unemployed. So when you made the adjustment for that footnote, the unemployment rate was actually 300 basis points higher, or 16.3% versus the 13.3% that was reported. So just a minor classification error there.
And we're going to see more and more of that. That means that you can't subscribe to fake news. You can subscribe to whatever you want. But if you want to start following people's misclassifications that don't read the footnotes, that don't read the cues, that believe anybody no matter what as long as the chart looks good, you can do that. But there are other people that are doing real work. And you in particular have done fantastic work alongside me over the years. So I know a lot of people have been waiting to kind of see who is the man behind the mask of the Hedgeye FIG handle. But now they got it. Thanks for spending some time with me, man.
Absolutely, thank you.
He's Josh Steiner. That's his Hedgeye Twitter handle, Hedgeye FIG, and I'm still Keith McCullough. We're still working together. We still get along. We still question things. Hopefully you are too. Thanks for joining us.